When it comes to allocating income across tax buckets, most people miss the mark completely. But today, I'm going to show you how I've managed to strategically split my income so that I'm paying the least amount of tax possible, while still having money in the right places at the right time. Stick around because I'm going to share an overlooked strategy you absolutely need to consider by the end of this video. So let's jump into it. Most people just see taxes as one big lump sum. But when you break down income into different buckets, it gives you a lot more control. The trick here is understanding how the IRS treats different types of income, whether it's salary, capital gains, or dividends. You want to leverage these buckets to your advantage. For example, the first bucket is tax-deferred income. Think about things like your 401k or traditional IRA. The money you put into these accounts grows without being taxed right away. But here's the catch. You will be taxed when you take the money out. So, I'm not putting every single dollar into this bucket. I reserve this for my long-term retirement planning. Now, let's talk about the second bucket, tax-free income. This is where I allocate any investments that allow me to withdraw money tax-free in the future. Think Roth IRAs or municipal bonds. The beauty of these is you're not paying taxes on the growth when you withdraw it later, which is a huge win. This is where I park a portion of my savings that I know I won't need access to for a while. Moving on to the third bucket, taxable income. This one is the tricky part, because this is where you pay the most attention to the timing of your withdrawals. If you've got money in regular brokerage accounts, this is where the taxes hit you harder. That's why I make sure that when I do take money out of this bucket, I'm only triggering capital gains taxes on investments that I've held for at least a year, so they get taxed at the lower long-term capital gains rate. But the most important bucket, and the one that's often overlooked, is the cash bucket. This is where I allocate money for short-term expenses or emergencies. Think of it as your safety net. I keep enough liquidity in here so that if something urgent comes up, I'm not scrambling to sell long-term investments at a bad time. The key is having just the right amount in this bucket. You want enough to cover those short-term needs, but you don't want too much sitting there collecting a low interest rate. Here's where it gets interesting. It's not about how much you put in each bucket, it's about the timing and how those buckets work together. By the time you hit retirement or a big financial goal, you want the tax-free bucket to be your largest. You'll be glad you planned that way when you're withdrawing from it and watching that money stay in your pocket while everyone else is getting hit by taxes. Now, I want to share something that many people miss. The biggest mistake I see is putting too much in taxable buckets and not enough in tax-deferred or tax-free options. It's easy to assume you don't need tax-deferred accounts early on, but in the long run, this is the strategy that pays off. Most financial advisors will push you toward investments that earn them commissions. But I'm not incentivized by anything other than making sure you get the best, most actionable advice possible. So, if you found this video valuable, don't forget to hit subscribe. This channel focuses on bringing you real, unfiltered advice, without the hidden incentives that other videos push.